Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, June 8th, 2020. It is 2:26 p.m. Eastern Time as I'm starting the video, so we have about an hour and a half left in the trading day. What we're going to do in this video is do updates on some of the recently highlighted short trade ideas, and that includes some, possibly all the official trade ideas, but I'm going to go back as I did in the other video. The previous video were long trade ideas, so if you go up here, trade ideas, and just click on the unofficial trade ideas tab, you'll load everything. And again, this will often include official trade ideas in here. You can see all the posts in chronological order in that category. And so we're not going to go back very far, but what I want to do is try to keep some consistency here on the ones that I've highlighted recently, providing updates to those. And so we're just going back here to the week before last. That is May 28th. That's last Thursday. Again, Thursday before last, that is. And you can see in there, there's been a mix of long and short trade ideas on the site recently. And what I want to point out here is that if you're listening to this video after reading the title, then it tells me a couple things. Most likely that you are a flexible trader. You're interested in short trades, whether you want to actually take them right now. Maybe you're in the learning process, trying to learn, all about trading. You like to watch the videos, whether you take the trades or not. So I do applaud that, because I think there's opportunities in at just about any point in time on going long and short, and I'm a big proponent, as I said in the last video, of diversifying, not just among different positions. Just having 10 stocks in a portfolio may or may not be diversified. If you own Apple, Facebook, Amazon, Alphabet, and Intel, guess what? You're not diversified. Those stocks tend to move highly correlated. They're all tech companies or tech related. They're all top components of the major indexes. And so in a 20-30% drop in the market, they're all going to go down 20-30%, give or take. Likewise, when the market rises 20 or 30, they all go up. So the proper diversification means you have money in different stocks that are in different sectors, or also different asset classes, meaning bonds, commodities, gold, and alternative assets such as REITs, maybe Bitcoin, a little of everything in there. And then, of course, a flexible trader is one who can, willing to go long the most bullish setups and short the most bearish setups. So now I want to say this. Now on that, without saying, it goes without saying, but it bears repeating, that shorting in a strong uptrend, we are in one of the most powerful, one of the most resilient uptrends that the market has seen in many, many years. I'm talking just over the last few months. It's been very strong and resilient. But with that being said, and the point of this video is a couple things. Technical analysis still works. As far as where the market's going now, again, it's exceeded my uppermost, bounce expectations from months ago. I was pointing out as we bottomed, we were short, mostly short trade ideas, especially bearish analysis on the indexes leading up to, but just before the lows, where at that point I made it clear the risk reward was no longer attractive for shorting, even if the market was going to go down, that the risk reward was to the upside, and pointing out divergences and other things that happen, and then of course going long after that. Now, with that being said, as far as the index has gone lately, it's one divergence after another, one trend line break, near-term sell signal that just, it's not that they didn't play out, they played out for much less than the charts indicator, at least my analysis. That's what I like to do, is make clear that, when things don't play out the way I want, or expect, I should say, it's because I missed something. I didn't read the tea leaves properly. There was something in there, and in this case, a lot of that will be, and I'm not going to blame this exclusively, but, I grossly underestimated the impact of the Fed, the magnitude of the extreme measures the Fed has taken. I attribute that to a large part of it. Now, with that being said, we're really, not in percentage terms that far above the very levels back in March before and right after the market bottom, where I figured this bounce might go. The tech sector, certainly that exceeded QQQ. Not so much in the S&P 500. And then finally, what I want to say, and as we go through this video, is and why I'm focusing on these individual trades is, if you go through the last video on the long trade ideas, and I hit every one covered over the last few weeks, I left out commodities and the dollar sensitive things because those are, of course, those are sectors, and they're kind of, those trades are tied together, and I'll do updates there separately. But as far as individual stocks is what I'm referring to. When you go over the longs that I just covered, of those that triggered breakouts, remember there was a difference there are differences, and were highlighted between trade setups, meaning trades that had yet to trigger an objective long entry or a buy signal, and those that were objective entries or did go on, or objective longs at the time, or did go on to break out. Now if you go back and watch that video, you'll see the vast majority of those stocks, I believe all of them, played out. Now you might say, well, Randy, of course, and, all ships are lifting a rising tide. So, over the last week and a half, 2 weeks, whatever, all those trade ideas should have played out because the market's been very strong. And if you take an average blended return, I don't have the time to do it, and I welcome anyone that wants to do it. Take it from the point of those videos, those that were active or when they broke out. What you will see is all those trades collectively vastly outperform what the stock market did over that period of time. So that goes to show that technical analysis does work, security selection does work, finding the most bullish stocks in a bull trend and finding the most bearish stocks in a bear trend or even in an uptrend. So part 2 of that will be as we go through this video, and I'm not cherry picking, I'm going to go through all the individual short stocks that were covered over the last couple weeks, and I'm not cherry picking points. I just want to keep it focused here so the video doesn't go too long, and go over those stocks. And then where I'm going with that, I think you'll see the same point that if you take them collectively, again, those short trades that have either triggered an objective entry, which some haven't, but if you take the ones that either triggered an objective entry or are official short trades on the site, you will see that on balance they have vastly outperformed, or done very well compared to the market. In other words, there's underperformance on the market. If the stock market goes up 10% and a stock goes up 5%, it's underperforming the market, and that's what you want. And of course, obviously, the goal is to profit on the short trade. So I just wanted to point that out, that if it was pure random, then the vast majority, if not all, of these short trades would be underwater, and underwater by quite a bit over the last week or two here, and that's not the case. So we're going to dive into the charts. I just wanted to explain that, and again, the reasoning for covering these trade ideas. Now, why might somebody care to short in a bull trend like this, a strong trend? As I said earlier, diversification, that's obvious. To hedge long positions. Maybe you have a portfolio, a lot of long positions, you're a trend trader, an investor, you don't want to take profits on those yet because the trend is up, but you do want to hedge, you want to have some shorts in place just in case you wake up to one of those big boom down days in the market, and you want to have those shorts in hand ahead of time. And then finally, in addition to diversification or hedging, is it's a pure play. You can, as I said, giving just about any market, bullish, bearish trend, you can make money sniffing out the most bullish long setups and the most bearish short setups. So if nothing else, just a pure play short potential. Okay, enough talking on that. We will go through the charts, and I'm going to tell you in this order right now. I'm going to give you the order, and we will not go back and reference the previous, where they were last time around, because that just takes too much time. We did that in the last video, but again, I spent a few minutes in this video talking about those considerations to make in trading and investing, and why I'm taking the time to go over these short trades, even though my guess is maybe half the people that might normally have watched one of the videos today probably didn't even open this one when it said short trade ideas, and those that did are probably skeptical. So my job is to tell you what I see and where the opportunities are, and your job is to decide what you like. Pass on those trades you don't. If the ones that you like mesh with your analysis, if you like what you see, trade it as you like. I give you targets that I think are objective, but you may use your own targets or entry points or anything else. So we're going to go back here to the 28th, again, Thursday before last, and we'll hit the individual stocks. A lot of these videos included broad market analysis, and I'm going to keep that out to streamline this. So we'll go over these trades, and I'll tell you the order right now if you want to skip ahead. Starting with this one, we're going through Berkshire, Costco, Domino's Pizza, that's, or I should start over with the tickers, BRKB, that's Berkshire Class B, COST, Costco, DPZ, Domino's, NFLX, Netflix. Then we go up here to one of these up here. We have Verizon, I'm not sure where it is. I'm looking down on my notepad. Oh, that was right here. Yeah, we still have it there. Verizon, and then up here, Adobe, Applied Materials, eBay, Fiserv, KLA C10 Core, NVIDIA, REGN, SBUX, which is Starbucks, VRTX, and then ZM Zoom. So that gives you an idea. We're talking, a little over a dozen names, and let's just dive into the charts. And I think again I think you'll see the point here that there is opportunities to be made, and right now any shorts that are break even, let's say, or close to where they were, only slightly underwater over the last week, or especially in this case the last several weeks, especially those that are profitable, that again tells you this, they don't have relative strength. They have relative weakness to the market. And when, it's not a matter of if the market takes another leg down or has a next correction, it's simply a matter of when. We all know that. And our when may differ. My when may differ from yours or the next guys or gals, but that's why I do these videos, because you don't want to wait until CNBC tells you that the market's in a correction. At that point, it's probably going to have dropped 15-20%. You want to kind of sometimes get ahead of these, and until the broad market gives us solid sell signals, maybe nibble and keep position size relatively light on these individual short trades. And then once the tide turns, that's when they should outperform. Starting out here, with all that being said, we're going to start out with Berkshire. This is an official trade. We shorted this one way back here on this pop there. We shorted it at 195.90. That was quite a while ago, several weeks ago. This is a weekly chart, and I made it clear at the time that this one was based on the long-term charts, on this weekly chart. As of now, we're only about 2% down on that trade. And again, the market over that period of time has gone up considerably. That was back on the week of, I don't have the exact date in front of me, the week of April 9th. And so we went quite profitable on here. But again, on this one, it's a longer term trade. I'm swinging for not necessarily a home run or a grand slam, but I'm certainly swinging for a double or triple on here. And we had longer term, pretty aggressive price targets. And the point is, this one, I like it every bit as much now as I did back then. This is a weekly chart. The basis for shorting that was this big negative divergence, breakdown of this large wedge pattern, primary bull market uptrend line. I mean, you can't get better than that. There's your primary trend line there out the 2009 lows. Impulsive breakdown, and we're still well below the pattern. So, as I often say, in life, patience is a virtue, but in trading, it is an absolute necessity. So when I put this trade on, I made it clear this wasn't your quick get out swing trade like most short side trades are. This one I'm giving room is a stock that I think put in a major top and started a bear market back here around the March highs or February highs. And that's how it looks on the daily chart. And we've rallied back now to the 200-day or 40-week exponential moving average, as well as that 272 resistance level, where it seems to have stalled out at. Stopped. We're still well below our stop. And when you look at the monthly chart, this is what Berkshire looks like. I'm going to tell you where I think it goes and why I may extend these targets if and when the charts, especially on the broad market, start to confirm this trade. I think ultimately, the stock takes this path down here and ends up going down to about the 102 level right there in this uptrend line. That would be about from where we're at today, a drop of about let's see, that would be a drop of about 38%, and from the highs I think it's about 55%, depending if and when we get there. So you're probably chuckling. I know some of you, if you're new to this, Randy, Berkshire, this is Warren Buffett's company, one of the best run companies in the world. Okay, well, here's the last two bear markets. We've had two bear markets over the last several decades here. First one was in the late 90s. That was the dot-com bubble. Berkshire back then fell 52%. Last bear market, other than the one that Berkshire's in now, it's still very much by all metrics, this stock's still in a bear market. But the last one, before all said and done, it fell about 56%. You might say, well, that was a financial crisis back then. What's happened recently dwarfs the financial crisis, in my opinion, and I think ultimately, by the time the charts play out. So what I'm calling for ultimately is a drop that is not any more. In fact, maybe a hair less than the average of the last two bear markets. So is as aggressive and crazy as that might seem to some right now, because I know the majority of pundits are calling for newer highs in 2020 and beyond, 2021 to be a good year, COVID, everything will be behind us. That's where I think the stock is going. My convictions are pretty strong. Here was the last trend line break and last bear market. And just kind of another thing to look at here is you might say, well, yeah, but this is over. This whole thing's over. Well, Berkshire's rallied right now about 27%, right? Well, here's the last bear market, topped right here. Here's our first bear market rally back in 2008. And from those lows, if I can grab the bottom of that candle and snap to it, I got it there, we rallied 27%. And then, boom, the rest came. This is, again, what I'm seeing in most stocks, the majority of stocks and the indexes, is nothing more than typical bear market behavior. The rally has been impressive, but as I said before, well before it even started, wait and see the next bear market rally towards the high. You'll be convinced that it's no longer a bear market and the market's going to new highs. That's the nature of bear markets. I've traded them before. This one back here, top came in Berkshire back in 98 before the dot-com bubble burst, but that was clearly our first wave down in a new bear market. That was over 50%, and the bear market rally back then was 43%. And stock still fell below, fell shy of its highs. And so the point I'm trying to make is when you look at the bigger picture, the longer term charts, and not get swept up in what happened on Friday and the fact that we've had divergences building on the charts that haven't been playing out yet. When you look at the bigger picture, these things take time. These are charts, these are monthly candles. But that's the technical analysis is all about, is studying charts, past price action, similar points in time, both on the business cycle, fundamentals, the macro picture, and technicals, and then using that and trying to identify similar patterns to project where prices are going. That's really the crux of TA. And you can see here, there's that 20-month exponential moving average that helps define bull and bear markets, and you can see that's where Berkshire is rallied back to right now. So I spent a lot of time on this one again for whatever reason, just to point out that that's where we're at, bigger picture. Now the daily chart, is this recent ramp impressive? Yeah, but it's been broad-based buying. Everybody just throwing money into the ETFs, the XLF, the financials, buying everything, expecting that the markets are going to go to new highs. But this right now, again, at the end of the day, if nothing else, we shorted this one weeks ago, and we're basically back to where we started. I mean, 2% drawdown for me, that's virtually flat, especially when I'm expecting, even if just the official target, not my final bear market target I just showed you of a 55% drop off the previous highs, the February highs, but even to this second target now, you're talking about another 25% downside. So I'm more than comfortable going 2% underwater, or even higher if we hit our stop up here to attempt to get that. And I can tell you this too: if we get close and we start moving down and the market is confirming at the time, I will most likely add additional targets and may extend this trade to target those longer term targets that I showed you on the monthly chart. All right, we will not spend as much time on each and every stock. Just that kind of paints the bigger picture and ties into all of these. These are big market leading companies, or at least well-known companies, all index components that I'm starting with. Costco was also based on the weekly chart. Let's zoom in a little tight here and show you what we have. We shorted that one somewhere around the time we shorted Berkshire. We entered at 301.55. That's my note right there, entry price. You might not be able to see it on there. We're at 308.31. That's 7 points on a $300 stock. You're talking less than 2%. So again, virtually flat. And okay, my point, well, while the stock market, especially tech, has been rallying, these stocks, although they've rallied recently, this is stalled out. So this stock is underperforming, and that just helps helps to confirm the case that it will most likely, if the market plays out ultimately for another major leg down, then these targets will be hit. And we still need to take out that trend line. I talked about that before. We have an uptrend line right here. Needs to be taken out to open the door to T1. And of course, once T1 goes with conviction, then T2. And then finally the third and final target on that one. And the other one, well, I told you I'd go in this order, so I'm just going to cover Verizon, but I'll get to that. DPZ, there's a weekly chart. Everything's the same. I've covered these in the past. And once again, guys, remember, when you go through here, I'm jumping back to the home page. You can click, if you want to see the previous analysis, click on the symbol. If I click right now, I'll do it. Click on DPZ. It will load all posts related to DPZ, including the the official trade that we have right now. So let's jump back to that chart and look at Domino's. Domino's, I was bullish on back here during COVID. Early on, then when they first started running the commercial, they're still running now. Hey, pizzas come out of an oven at 450 degrees. They're not saying it, but I'll tell you, if that doesn't kill a virus, what will? It doesn't touch human hands. Everybody was cramped up in their homes. We have 2 teenage kids, so believe me, we were supporting Domino's stock price, and still are. We've tapered off a little bit down here. All our restaurants are open where I'm at, and they have been for a while, but anyway, so I was bullish back then, and it ran full circle, so switched to bearish. We entered that one at 369.27. We quickly hit our first target. The reason I list multiple targets on the site, that's where a bounce is expected, a reaction, and that's what we had. We kissed my target almost to the button, had the expected reaction off there, which has been a little longer than I had expected, but with that being said, it's a reaction. It's hard to tell if they're going to do this, and a lot of this is because Domino's is an indexed stock. It is a component of a lot of the major indexes. So what's changed since we entered this? Not much. The divergence line gets extended. They've come close to our stop. I don't plan to modify that, at least at this point in time, but the negative divergences that were in place at the time are now only larger, and really there's not anything clear in the chart until and unless we break that former support level. The first target, which the support's actually about 349.38. I always set my targets a little above support on short trades, and you can see the additional targets there. So is it one of my favorites right now? No. Is it an objective entry? Not really, not based on the daily chart, because we're in what I call no man's land, which is between support and resistance. But I did want to do an update on it. I think there's better fish to fry at this moment, but if it starts to come on down here and takes out T1, I think that opens the door there. And again, I see no reason to modify the trading plan on that one. Just leave it in place. Same stops, same targets. And that's assuming that you didn't book profits at T1 and get out. Netflix. Netflix is another example of a short trade. So right now I've gone through 1, 2, 3. These were all official short trades so far. Berkshire and Costco, as I said, almost flat, 2% down after going much more profitable than that so far. Domino's already hitting a first price target, so that's a short trade that's bucked the trend. And Netflix is an official trade, and that's another one, and once again, that we've shorted in the last few weeks. We shorted it at 440, so we're still comfortably profitable. It's still good by about 25 points. At this point in time, we already hit our first target for a quick gain. I can't recall. You want to see where it's at, just go back here and find Netflix in one of these and click on it. I'd have to go back here, and that'll load all the other details on it. Like a lot of the official trades have been kind of really behind on posting updates. I've covered it when it was hit in videos, but you don't see it on here. The only update on the official trade was the entry point. But once again, it's already hit the first target there. Came very close to, but reverse shy of our second target. And it's another example of a trade that is, or a stock that is not participating in this rally. And if you're a stock and you're not rallying right now and you're not set up in a bullish chart pattern, there are some that I'm looking at. I like stocks that maybe haven't participated but are setting up bullish falling wedges, pullbacks to support. This isn't one of them. This is one, again, the case was made for the short, so I'm not going to go over that now. I just want to mention it looks good. And when I look at the daily chart what stands out to me, even though we base the short trade on the 60-minute chart, is I see what appears to be a bear flag pattern. There's a flagpole, impulsive move down, actually all the way down there. Little flagging action. It broke down recently. Not moving impulsive. I'd like to see some impulsive selling from here, and if so, that could open the door for another leg down. But as of now, looks good. It's bounced back to resistance. Remember, this former first target at 419.85 was set just above the 419.84 resistance level, and boom, that's what we've been tapping. We regained it, tap, tap, tap. We're rejected here, so this is kind of just the play-by-play on it. And it helps to know, to try to figure out where a stock is going, you have to look at where it's been, I always say. And so we broke it, came back tested, failed. Took it out. Okay, so that should be bullish, right? You took out a former support, now resistance level. But no, then we started testing from above. We couldn't follow through, or the stock couldn't follow through. And then boom, broke it, and now boom, hit it again. So say what you will about where you think Netflix is going, but I think you find it hard to argue that this 420-ish level right there is a significant technical level, because the traders are stepping in, and we're below it right now, which puts Netflix in a bearish technical posture until and unless that level is solidly taken out. And of course, at this point then, if they do take it out, you'd want to see a break above these recent highs. That might change the dynamics or the outlook for this trade. But as of now, based on the divergences and everything else in place, it still looks good. Okay, next up, Verizon. This is also an official trade, and also one based off the weekly chart. That's what we're on now. If I base a trade on a weekly chart, it means that is not a quick in and out swing trade that may last a few days to a few weeks. It is a trade that is expected to play out for months, sometimes even years, depending on the chart. Typically not short trades. They can play out for years, but usually I'll look in months. Again, if this is a topping play, then yeah, I could see certainly the possibility this trade, this stock continues to fall into 2021. I measured the peak to trough drops before, following divergent highs or breakdowns at 30%, 25, 22, and I said unlikely, that's it. Back here was a 55% drop. There was your last bear market. So again, looking at previous bear markets helps to put in perspective how much these stocks can fall. And if you are a believer that we'll never have another bear market again because of the Fed, that they figured it out, then don't watch these videos on short trades if you're not interested. But that was a 62% drop, and so based on all the technicals, like I said, it's unlikely that the 22% drop was it for that stock. More likely just a first leg down. So where are we on this one? We shorted it at 57.94. And we're profitable only by a few cents, so I call that flat. But again, the point here is, here's another stock, and this is a heavily indexed stock. It should be going up with the market, but it's not. So that tells me we shorted back here. We were profitable, quite profitable, nothing big, but and we've been profitable since shorting this. We've not gone underwater. We're comfortably above the stop. The technicals are still, the case that was made to short it before, we're right back to where we started. So I think the same case can be made now. The trend in the market's pretty resilient. I can say, my convictions aren't as strong right now today to short as they were back then, because I would like to see some sell signals in the market. Market has bucked a lot of divergences and went through resistance levels that it quote unquote should have stopped at, and it hasn't. So one to watch, and maybe one to, if you're in it, not in it, one to consider if we start to see the market roll over and get some pretty decent sell signals there. This is one that I think will outperform the S&P 500 as a whole on the way down, and so that's that. Now, the recent rally, was technically induced. I think I might have covered this in one of the recent videos. You had a little bullish falling wedge, positive divergence on the 60-minute chart, and this just kind of speaks to trying to capture the bigger trend. Most people can't do it, whether it's a bullish trend or a bearish trend. They second guess all the moves against them, but to capture the big move, if that's what this is, you're going to get these divergent lows. This one was pointed out back then. That was the catalyst for this rally. Divergent high was a catalyst for this correction. This divergent low was the catalyst for this rally, and so forth and so on. So when does the next leg down come? Well, quite likely when this trend line here is broken. We may or may not get, actually we do have we have RSI divergence right there. So yeah, it's quite possible since we have the RSI divergence, we get a break here. That may be the catalyst for the next leg down. Okay, and Adobe was highlighted a week or so ago as a short setup, but at the time, and I still maintain this. I said probably best to wait for a sell signal and a break of this trend line. I had highlighted that we had a bearish engulfing candle, as we had on so many other major tops in Adobe in the past. 1, 2, 3. Maybe even more if we go back farther. However, we've moved back above the top of that bearish engulfing candle, which no other way to spin it, but it just kind of takes away from the the impact of that, or the potential for a topping stick. We only had one confirming red candle, and after that it was all green candles. So again, most importantly, we're above trend, and as I said in that last video, so that one would be an untriggered trade. You need to break trend just like you did here. There's your breakaway. You had a impulsive gap down below the trend line, and we'll look for something similar on Adobe here as the stock wedges higher. When you zoom down to the 60-minute chart, you can see we have a primary trend line right here off the lows back in March. We need to break that. So that would be probably the same trend line I just showed you there. You can see we're diverging right here, meaning the indicators are lagging behind. We had a divergent high there. We had a breakdown, and this is kind of the example I've made. You know, a lot of these breakdowns, it's not as if the divergences didn't play out, but they didn't play out for nearly what I figured they would, or what the charts indicated they would. In other words, there's just been a lot of fuel driving this rally, a combination of the improving economic situation, which again, it baffles me because I don't know how many people thought we'd be on lockdown forever. I mean, I think most people agreed people are going to come out of their houses and go back to work regardless, even if the virus is still raging, regardless of what the state governors are telling them to do, because the world must go on, and that'll be the case if we get another bad flare-up. I hope we don't, but people realize there's going to be more lives lost and longer-term damage caused by prolonged shutdown. The economy cannot tolerate another shutdown to the extent or even larger than the one that we recently had. I think that's just a given. I think whatever, people are going to work through this. How does it look in the future? I'm getting off topic. I think the young and healthy, a lot of those are in the workforce that have a much lower risk factor, will go back to work. I can tell you where I'm seeing it here. It's like we haven't missed a beat down here in South Florida, for West Coast, and not on the East Coast. They've got a different situation over there in Miami and all that. That's where I'm from originally. Got a lot of family down there, but here I've been doing a lot of improvements on the run up to Home Depot and Lowe's, and doing some things on a new house we bought recently, and in there all the time, and you wouldn't even know that there was COVID with how busy Home Depot has been down here. So I just want to say that it's business is back to normal, and so the stock market rally is a combination of that. The Fed, liquidity injections and everything else, and support for the market in combination with the economy getting back online. But with that being said, it's now been declared, that what just came out today, the NBER declared we are, let me grab the headline for you. Okay, I haven't even read the article, but the headline came across in my inbox. Recession in U.S. began in February, NBER panel says. Longest U.S. economic expansion on record came to an end in February. Well, my point is that wheels have been set in motion, and we're back. Economy, everything's coming back online, but it is not, and will not be 100% for quite some time. The big question, and will it be 70, 80, 85, 90? But I think it's safe to say, and we're not going to see, when you see sports stadiums at capacity, concerts, airlines, airports as busy as they were back in January and February of this year, as many planes up in the air, then we're back to 110% or 100% of where we were. So to see so many stocks at or even above their highs does not mesh fundamentally. And the technicals, again, are the guides. So you're watching Adobe. Again, I digressed a little bit, but I just want to say that there's a lot of meat on the bone on many of these shorts, and these are the levels to watch. After this video, or either sometime today or tomorrow, I will follow up with the 11 sectors of the S&P 500. They're still above those trend lines I've been highlighting for a while. We're still waiting. Sell signals are pending. They haven't happened yet, but that doesn't mean they won't. So we're going to watch those. And then when we get these short trades, again, the ones that I'm highlighting here, I would expect, on balance, collectively, given sell signals on each of them or objective short entries will outperform the stock market. So you can either short SPY or QQQ, or you can, if you have the time and inclination, short the stocks with the most bearish looking chart patterns. All right, next up was AMAT, Applied Materials. That along with KLAC, which I'll get to in a second. These are the big chip equipment makers. They are, if the semiconductors are the canary in the coal mine for the tech sector, which I believe they are, and some consider that, then the chip equipment makers are the canary in the coal mine for the chip stocks. Because when they start to see sales drop, that's Intel, Texas Instruments paring back on their chip equipment, and so that's usually a heads up. So we'll watch these. AMAT, I believe I would have said the other day, we had resistance up here, no sell signal, we need to break this trend line, and it's rallied into the bottom of that resistance level right here, resistance zone I should say, which runs from about 61 up to 62.50. So far a reversal there. No sell signals in place at this point in time, so we'll continue to watch it. You can put a trend line on the 60-minute chart, and you can see same story. A lot of these stocks are just walking up these trend lines with sell signals pending. So nothing there yet. Next one up, going in order that I told you I would. I'll get to KLAC in a second. eBay. eBay, like I said, no sell signal yet. Needs to break this trend line. That was what highlighted. We had a big candle, huge, big gap up, big green candle. So far that's being faded. Looks like they're going for a gap backfill. At least they've entered the gap right there. And again, they need to break this trend line to trigger a sell signal, and that has not happened. So this is another potential short setup, not an objective short entry or an active trade at this point in time. Fiserv, SISV. Mentioned that one is an objective short. It is an objective short, was and still is, on a back test of this trend line. This is a long-term trend line, roll back all the way here. You can see that trend line coming up from 2014. Lots of reactions. We had that little meltdown back in the fourth quarter 2018, snap back above it, and the stock continued to respect it. So I still think it's valid. Back testing it along with a confluence of moving averages there, and like I said, the broad market's holding up, so when you short a back test, sometimes you can back test once and back test again. At this point, that's why I just added this line. I think a break of that trend line will probably do the trick, and you can go down what I just did to a 60-minute chart, put a short-term trend line there, and maybe set a price alert for Fiserv. Targets, well, I think I probably shared this one last time, about the 150 level would be my first target. And if the stock breaks down, triggers a sell signal, or reverses off there, like I said, it's an objective entry, but shorts are, even those that are playing out aren't playing out very well because of the resilient trend in the market. But again, not to beat a dead horse, but that will not last forever. And when we do finally turn, it could be a slow roll or it could be a crowded rush for the exits. So I do these videos in advance so you can be prepared and jump on these if you're looking for short trade setups. Next up would be, Fiserv, KLAC. Okay, another big chip equipment maker, needs to break this trend line just like AMAT. So still above trend, broke above the previous high. Watch this. If we drop back down solidly below that 184-ish level right there, I'm going to lower that line a little bit, call it 184, then that will be a failed breakout, especially if you can then break below the trend line right here. So anything down here, especially impulsive, will mean two things: a failed breakout above those previous highs, as well as a break of this uptrend line off the lows. And divergences are a little sloppy, almost being taken out now. It's roughly equal highs on the both of them. The RSI made a slightly higher high, but again, trend line, I'd put a higher weighting on there and watch that trend line. So that's, again, to be clear, an untriggered short setup, still pending an objective short entry. NVIDIA, talked about NVIDIA recently. We had a bearish engulfing candle. We had an island cluster top, meaning all these candles formed a cluster, separated with a gap on both sides, gap 1, gap 2. That one wasn't huge. The strategy on that one is that you can short the breakdown or the bounce back, the gap fill, and I like to put typically set a stop about 2/3 of the way up into the candle, so we're still a little bit below there, and I think it still looks good. Especially now, I mean, we're closer where it's set a stop. I mean, the risk reward, if you get stopped out, let's just say hypothetically here, you go in. Well, let me grab where we're at today. We're roughly here at the bottom of that red candle. So let's say you shorted here with a stop above, somewhere around 2/3 of the candle, about 3% stop. We'll do it right there, 3% or so, right? The downside targets for this one. First of all, an island cluster top is a topping pattern. I didn't mean to put in a major top. And you'd be looking for, I would at least, a minimum. First target right there is 315.70. That's a 9, almost 10% drop. Second target down here is about 18%. And again, there could be a lot more. I know it's every time as the market inches higher and some of these stocks make new highs, fewer and fewer people believe that we'll revisit or test or especially undercut those recent lows from March. But imagine if we do, and again, that's how I look at trades from a simple, risk reward perspective. Just to revisit that low would constitute a drop of about 48%. So to risk 3% to make 48% or more, I think it's attractive. The only thing better that could be better would be obviously a reversal in the broad markets, because again, this was a nice setup, but Nvidia's it's not gone down yet after that island top and the bearish engulfing, because the broad market's been so strong. But it is showing relative weakness as well. With the Qs and the tech sector making new highs recently, this one didn't. So again, I think there's more bang for your buck on a Nvidia short than a lot of other things out there right now that are heavily indexed. All right, next up, we're almost done. Just a few more. Here's an example of one that is playing out. RGEN. No, maybe it wasn't this one. Maybe it's the next one. I'll get to one in a second here. This one, oh gosh, I'd have to revisit my notes. Is the divergence here? I can't recall if we covered it here when it broke down, but it's back tested. It continues to diverge. And it does offer an objective short entry. We had a breakdown, a back test. It shot in a wedge, but it's rolled back down. Not one of my favorites, and that's also because it's a biotech stock. So you got to be careful with the biotechs, because you have to know them. Do your due diligence. Are they a very diversified biotech company like Amgen or something, where they have tons of stuff in the pipeline? Or is it a smaller biotech where everything or a lot is riding on one drug in clinical trials? And if that drug gets approved, great, the stock can skyrocket. If all of a sudden it comes out and people are getting sick or dying, there's adverse effects on the drug in clinical trials, phase 1, 2, 3, boom, the bottom can fall out. So that's just want to say there's an extra risk with biotechs that you don't have in just about most sectors, most stocks. Your biggest worry is earnings, and that's well telegraphed in advance. You know exactly when a company will report, so you can manage your position, hedge up, cover the position, or go, sell it before earnings if you want. Whereas a biotech, you got to worry about earnings every 3 months, but then you also have to you can't control the clinical trial data, because those things can be announced randomly, an approval on a drug or a denial, or like I said, unfavorable results in clinical trials. So enough on that. Probably shouldn't even talk so much about it because it's not one of my favorites, but again, I'm just following up on the ones that I covered recently. Starbucks, there's your trend line, no sell signal yet, needs to break that, but I did say about a week ago or so, last time I covered it, if I recall correctly, I said we don't always get what we want, but the ideal scenario, we were right here at the time, this line. I added this one today. I said the ideal scenario, because Starbucks was so close to resistance, would be that it pushes up here to about this $82 resistance level right there. It's a big level. We're at 83 now, but again, when you're 1 point on an $82 stock is almost nothing. So for all intents and purposes, we're at resistance right now. Again, there's the resistance line. I'll just highlight it there. And so that's the ideal scenario. And the divergence has been extended. So you can do one of two things. You can short it here. Now, the fact that we're a little bit above it, resistance, you might want to wait for a reversal. And again, also with the broad market still in rally mode, you have a little doji candlestick. So my preference would be to see if tomorrow we can get a big red candle following this. If we close with this doji like this today, maybe a starter position there, but I certainly wouldn't go to a full short position on Starbucks until and unless we get a break of the uptrend line. That's probably most important. All the better too if the broad market breaks down. You might not want to go to a full short position on anything until the tide changes in the broad market. All right. Next up, VRTX. Only 2 more to go. VRTX. There's an example one. All right. So this was covered recently. This is a biotech stock, again, high risk. It's just a beautiful display of technical analysis. And what you have in here, you have a cleanup trend line right there that was broken impulsively, giving you a sell signal, a perfect back test, and then it's rolled over since then. So since the back test right there, just the other day, a week or so ago, this one has dropped about 10%. So here's another stock that is swimming against the tide. Market's been rising over the last 2 weeks, and this one's been falling. And finally, last but not least, Zoom. Zoom, I mentioned before, is a potential short setup, not an actionable short, because it needed to take out both this downtrend line and that support about 154. At this point, it went up since then. So at this point, the trend line is going to come in first now. When I covered it a week or so ago, they both came in together. Roughly, I'm going to just round that up. I'm calling this a round number, 154. So you still need to break the trend line. What's happened since then with this thrust up? It's put in a divergent high now, or extended the divergence, I should say. And so again, I don't see any sell signals at this point in time. But if and when the trend line goes, especially if it goes up here, let's say at a higher level where my pointer is, that would then make 154 your first target, 132 and change your second target, and ultimately, again, depending on what the market and what this stock does, maybe all the way back down here to 102. I can tell you, almost certainly be my final target on Zoom. Until then, it may not even ever morph or develop into a short trade, but if so, that'd be about a 50% drop right there. Okay, long video. Again, I just wanted to kind of share my thoughts early on about diversification, about security selection, how is this, and especially the last video shows that how both the longs on balance, those that triggered objective entries, have outperformed the market, and here on the short trades, we're either some of these are either profitable or maybe not profitable, but also not at a loss either, and showing relative weakness to the market, and that's what you want to see on the short. So all the better if and when the market finally breaks down. So I'll wrap it up here and try to get an update out to you guys on the broad market and the metals soon, the metals and the currencies. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.